So, the recent Budget 2026 announcement. Everyone was talking about derivatives trading, right? But what if I told you the real story, the one that might affect your long-term investments, was hiding in plain sight? Yep, there's a hidden cost that just got a little bigger, and we need to unpack it. Let's get into it. Now, I know what you're thinking. Hey, I'm just a long-term mutual fund investor. All that trader talk, that's not for me. But here's the thing. A change that was supposedly aimed at traders is now creating this invisible drag on some very common mutual funds. And you're going to want to know about it. And that is exactly what we're going to dig into today. It's what's known as a friction cost. Think of it like this. It's an expense that's not on the main price tag, the expense ratio, but it's definitely there, quietly eating away at your returns. And yeah, because of the new budget, this sneaky little cost just got more expensive for some funds. All right, so to really wrap our heads around this, we've got to understand how this friction actually works. Let's pull back the curtain on these internal transaction costs. Okay, so here's the deal. Every single time a fund buys or sells something, it has to pay for it. You've got brokerage fees and you've got taxes like the Securities Transaction Tax, or STT. But here's the kicker, and this is so important. These costs are completely separate from the total expense ratio, the TER, that you see on the fund's website. They get taken out before the fund's daily price, the NAV, is even announced. It's like they're skimmed off the top before you even see the total. And that's exactly why we call it a hidden cost. See, if you're a retail trader, you see that STT charge right there on your statement. It's a line item, clear as day. But inside a mutual fund? Nope. It's just an internal cost that quietly shaves a little bit off the fund's performance. You never see the charge itself. You just see a slightly smaller number at the end of the day. Okay, so now that we know this cost is out there, the big question is, which funds are really feeling the heat from this STT hike? Because, and this is key, not all funds are created equal here. Right at the top of the list, the ones getting hit the absolute hardest are arbitrage funds. I mean, their whole reason for existing is to trade, trade, trade. They're constantly buying and selling between markets, trying to catch these tiny little price differences. High turnover is literally their entire game, so you guessed it, they are paying these transaction costs all day long. And this table really lays it all out for us. You can see arbitrage funds at the top, high impact. Why? Because they're constantly rolling over futures, which is what got hit with the tax hike. Then you've got equity savings funds. They get a moderate hit because, well, part of what they do is arbitrage. And finally, balanced advantage funds, or BAFs. For them, it's variable. It really just comes down to the fund manager strategy. The more they hedge their bets, the more they trade, and the more of this hidden cost they rack up. Whoa, let's just stop and look at that number for a second. Almost 0.5%. 0.45%. I know, it might not sound like a huge deal, but this is an annual drag. When you let that compound year after year after year, trust me, it adds up to a very real, very noticeable amount of money. Okay, enough with the theory. Let's make this super practical. What does this drag actually look like over a full decade of investing? We're going to follow two different investors and see just how much this hidden cost can impact the final outcome. Let's crunch some numbers. All right, let's meet our two case studies. On one side, we have our lump sum investor. They put down a big chunk of cash, 10 lakh rupees, all at once at the very beginning. And on the other side, we have our SIP investor. They're more methodical, investing 1 lakh rupees every single year for 10 years. Now notice, they both end up investing the exact same amount, 10 lakhs. And so their investment journey begins. But look, right out of the gate, they hit their first little bit of friction, stamp duty. Yeah, it's a tiny amount, but it's proof of our point. From the very first day, not every single rupee you think you're investing actually gets put to work in the market. Okay, let's fast forward 10 years. Now, pay close attention because this slide is where it all comes together. That gross corpus number you see, that's not the full story. It already has a decade's worth of the expense ratio and that hidden STT drag taken out of it. The damage has been happening bit by bit all along. Then, on top of that, you get hit with the long-term capital gains tax. That's another big slice taken out before you arrive at your final in-hand amount. So, for our lump sum investor, after 10 years, their initial 10 lakh rupees turns into just over 31 lakh. That's the final number, the money that actually hits their bank account after every single cost and tax is settled. And what about our SIP investor? Well, their 10 lakhs, invested steadily over the decade, grows to a final take-home amount of just a little under 17 lakhs. So you're probably looking at those numbers and thinking, wait a minute, that seems lower than what I'd expect. And you're right. So what's the deal? Let's break down the three big culprits that are responsible for this drop in your real return. Wow, this chart just says it all, doesn't it? Look at that gap between the assumption and the reality. Our lump sum investor was hoping for 14%, but their actual in-hand return was closer to 12%. And the SIP investor, who was banking on 11%, really only got 9.5%. So where did that missing return go? And here they are, the three big drags on your returns. Number one, the expense ratio. That's the one we all know about. Number two, our hidden cost, that internal STT drag. And number three, the final boss, the capital gains tax you pay when you sell. It's the combination of these three that takes that nice, big, shiny number and turns it into your actual, real-world take-home profit. And that's really the bottom line here. That difference, that gap between the return you thought you were getting and the return that you actually get to keep, it all comes down to these three things. It's a mix of costs you can see and costs you can't. So, to put a bow on it, what was the total damage? For our lump sum investor, all these costs shaved off nearly 2% from their annual return. For the SIP investor, it was about 1.5%. That's the real-world impact of all this friction over 10 years. And that really brings us to the final and maybe most important question. It's so easy to just look at the advertised returns of a fund and dream about the future. But what we've seen today proves why you have to dig deeper. So I'll leave you with this. After you account for all the fees you can see, all the hidden costs you can't, and all the taxes at the end, do you really know what your investments are earning?